All right, everybody. I am super excited because today I've got my good friend Darell joining us today to talk about venture debt. And, I think venture debt's one of those things that not a lot of people know about, but plays a huge role in helping companies grow and achieve really big outcomes. And so I thought it would be great to bring him on. He's been working in the career for how long? How many years
About
now?
12 years or so.
12 years. Yeah. So almost as long as I've been in venture, he's been on, doing venture debt. So definitely an expert, and so excited to kind of dig in and learn more about that. Darell and I first met way back in the day when we were both at University Venture Fund and worked together back in the college days. And, he's gone on, like he said, and has worked for a number of different banks over the years and has helped quite a few startups raise additional capital through kind of a lending model or security, right? And so I'm going to turn it over to him to maybe just talk about where he's at today, what kind of stuff he does, a little bit about his career track. So Darell, take it away.
Sure, thanks, Peter. So I'm at Pacific Western Bank now. I've been here almost 4 years, and the way we think about venture debt is a little bit differently than some shops, but we're doing deal sizes from maybe 2 million on the low end to about 65 or 70 on the high end. So it's a pretty big range, which means, early stage, mid stage, late stage. For us, late stage is still pre-IPO companies. So there's still VC backed, companies. Before this, I was at a non-bank called Ventsource, and before that, City National Bank in their tech practice, and Comerica Bank. So a few different ways of looking at debt, if you will, but it's really supplementary to venture capital. Sometimes people think it can really replace venture capital, but usually not. It's really complementary.
Yep. And how did you like discover venture debt? Like why did you head in that direction?
Yeah, good question. So at first I was looking broadly at commercial banking, commercial lending. So I actually landed in a group that was doing lower middle market. So think like, 20 to 100 million revenue companies with 4 owners that were never going to be VC backed. But that particular bank, Comerica Bank, had a tech practice. And so I rotated through there and got a taste for it. And there are only a few banks that do venture debt very well. There's also some non-banks that might be 2 or 3 or 4 times more expensive than sort of venture banking. But that's where I got my start.
Got it. That's great. And what you're at Western Pacific today, if I remember correctly, they acquired, was it Square One? Is that right?
That's right. So PacWest or Pacific Western Bank, it was about 7 years ago. Banks don't always do a great job at rebranding. And so sometimes people still think of it as Square One. It's hard to believe it was 7 years ago. But yeah, we rebranded about 3 years ago. And it's just given us an incredibly larger balance sheet. So a large deal for us, before the acquisition might have been a $20 or $25 million deal. And now that's probably middle. And we can start out, we don't always have to walk then run, but sometimes we do. And, so we'll see $60 or $70 million deals at our first bite at the apple.
Yeah. I just bring that up because I know when I started working in venture, Square One was like one of the very, very few in the venture debt space at the time. So it's kind of like one of the OGs, right?
Yeah. 2005. So it feels like a long time, right? There are a couple of, probably 2 players that are still alive that have been doing it longer. But that's one thing. You always want to work with good people. You want to work with smart people that understand the business model. So like if you're an entrepreneur looking at venture debt, you're going to probably appreciate people that ask the better and best questions and understand your business model, because they can be an advocate for you when it matters down the road. But I think not just that, but sort of brand and staying power of working through different cycles can help and be worth maybe paying a small premium for when you're looking at terms and term sheets.
Yeah, makes sense. So you said earlier the venture debt is supplementary to venture capital. What do you mean by that? Like how does a venture debt deal ultimately get structured typically?
Yeah, if you pull back, if you predate me like 15 years ago, and some debt shops still look at it the same way, but 15 plus years ago, there were a lot of folks really, we all piggyback on venture equity, VC backed, the VCs that are in a deal are underwriting and doing way more due diligence. They're going to be like calling customers for references. We're going to piggyback a little bit on that. But a long time ago, it was more of like, who funded the deal, how much they put in, almost do it as a ratio. And it was like who was funded and well funded by great VCs versus what companies are fundable going forward. And so that's flipped a bit. And I would say that, so like one of the key criteria that we look at is to make sure that, a Series A and on, so institutional backed, probably not just a corporate VC, and certainly not like a hedge fund or, just angels or something, but a real institution that has likely raised multiple funds along the way and has a track record for backing or supporting the companies if they don't do exactly what was planned. And so there's that is usually the first step, but beyond that, there's a lot of art and science with venture debt.
Yeah. It's interesting as a VC, we really like it when a company is able to raise venture debt because it really kind of extends the amount of capital that a company can bring on board for growth without taking additional dilution in many cases, right? Because it's debt, it ultimately gets paid back plus interest. And so for a VC, it's great. And can you talk a little bit about how these rounds get structured, from like an interest or warrants or how that all looks?
Yeah, sure. So typically the best time to raise venture debt is when you don't need it. And what I mean by that is on the heels of equity, right? So if you come to us and you've got 3 or 6 months left of runway, maybe there's a non-bank that will charge 3 or 4x what we do. Maybe they'll get involved, but maybe it's just really an equity risk. And when I say equity risk, I mean, even convertible notes is really just unpriced or convertible. It's going to be equity, right? So, whereas, we're going to get paid back at some point, and maybe it's in M&A or an IPO, right? Like we're going to be along for the ride. But, I would say, how are these structured? Well, put them in place when you don't need them, when you still have lots of runway. Negotiate as long of an interest only period that you can without paying back, or even a drawdown period. So, one benefit from taking venture debt from us is that we won't require any draws. So if you get a 15 or 18 month interest only deal with us, you also don't need a draw. And if you elect to, it creates optionality, right? And it can really pad that balance sheet going into the next round. And so there's a little value add there, but to your point, there's an interest rate, maybe 6.5% today, because prime is now 5.5. So banks are typically in the prime +1 range. So think 6.5. The coupon rate for the non-bank might be 8 to 14%. And then the warrant coverage for a bank might be close to 1% of our commitment amount. So if you think about a $5 million venture debt deal, 1% warrant coverage might back into like $50,000 today. Now, could that be worth $1 million later? Sure, right? But that's kind of, and that's give or take. I mean, that's a rule of thumb, right?
Sure.
Whereas a non-bank might be 3, 4, 5, 6% warrant coverage. I've even seen 12% coupon rates at a non-bank and a 12% warrant coverage, right? Which is just, 24% kind of sort of cost of capital when you ignore the fact that the warrant might leap in value later, right? So,
Sure.
so it's really apples and oranges between, if you can qualify for bank financing and it's friendly, I would take it, but there are non-banks that can maybe take a risk that we can't, or sometimes do a size that we can't at the moment, if it's really needed.
So I want to dig on that a little bit, but just to clarify some terms for some of our viewers that aren't familiar. So a warrant, that's kind of like an option to buy equity in the future, right? So as a bank, you get kind of these options, these warrants to buy shares at a future date. And that's why, they could be valued at like $50,000 today. But as the company performs and does well, and eventually, if they're successful, could be worth, 50,000 or could be worth $1 million in the future, right? And for the bank, like you are loaning money, but you're not investing in the company, right? You just kind of get these options that you can exercise later on.
That's right. Yeah,
and then interest rate, that's and that's just kind of what's being paid back on the overall loan amount. Loan amounts, what do you think kind of the average is for
for us, it might be in that 20 range, just because we do kind of 2 to 60 or 70. I would say there is sometimes a limit to how much term debt. So when you think about a term loan in venture, it's not to buy equipment and immediately amortize off. It's really just a fun sort of runway or cushion on the balance sheet. So, sometimes a company like a Series A or B or C company might be limited to, 3, 5, 10, pick a number of term debt, whereas the rest might be a line of credit. And what's become very popular over the last 5 or 10 years is a line of credit tied to turns on the monthly recurring revenue. So that might be 3, 4, 5, 6x. Rules of thumb for how much you can qualify, are just that, right? They're not perfect. But it lacks the context of what's going on at the company and the funding and the traction and the structure of how much they can get access to right away, or if there's a financial covenant. But sometimes we'll do a term loan and a line of credit, and the line of credit they're kind of growing into over time. So the facility size might be another $10 million for a line of credit, but really the monthly recurring revenue today is less than $1 million. So they just got to grow into the next 2 or 3 years.
Yep. If I'm raising like a $10 million round, Series A, Series B stage, how much, kind of rule of thumb should I expect to be able to raise in venture debt?
Yeah. So the rules of thumb, again, maybe a third of what you've raised, if you want to think about it that way. And others will also, especially some non-banks, but we'll look at like maybe 1x ARR or 12x MRR. But again, those two might vary dramatically. So, but those are 2 different rules of thumb that might triangulate to the right spot. If we've never worked with any of the investors, and $10 million seems like a very small raise for institutional capital almost anymore.
Especially these days, right?
Yeah, exactly. So, and that could shift with the valuation correction that's happened this year. But it dramatically changed. I mean, we had a Series B company raise 20 and we gave them 10, which sounds like a huge ratio, especially because they were doing less than $2 million in ARR. But the 10 was like 5 in term. There was a covenant stepping in at that point to require them to do something, relative to the plan they put before us, and the rest they really need to grow into.
Yeah.
So,
interesting.
But it's still super useful, right? And like when you think about like over leveraging is a risk, for some companies, I think the more entrants that have come in over the years have forced us all to be more competitive, which is a good thing for entrepreneurs. It's a great thing for, VCs and founders that are dilution sensitive, that want to have something else in the cap stack that's not so, just equity. But I would say that it's also pushed us to do more and more. And I think sometimes we need to work in, almost in tandem and consult with VCs that are on the board, as well as management team, to make sure that they're using it prudently, right? Like you would never want to use venture debt for a Hail Mary, right? Things are going terribly. We're doing 20% of what we planned on doing. Let's get some venture debt, right? Because it could really actually hamstring sort of the next round from coming to pass, right? And equity, you don't really need to pay back. So you'd rather, if there's something that's kind of going to be a binary outcome, maybe not use debt for that.
Yeah, I know I've been in situations in my career where the company has been in a challenging position because they kind of got a little over their skis, raising venture debt as part of that, right? And that really did kind of hamstring them, to your earlier point, when they went out to raise more capital. Right, because investors were kind of like, oh man, you've got this like 3 million, 4 million, loan you got to pay back that's coming due, right? So if I invest equity, it's just going to go right out the door to pay back the bank, and that's not super exciting as an investor. So yeah, I think it's something definitely worth considering and watching out for. It feels like a lot of excuse me. They'll edit this out, so. It feels like when you're evaluating and underwriting typical debt, you're looking at cash flows, right? Like how much profit is the company generating that can be used to pay down the debt. In the case of venture, most of the deals that we're going to back will never be profitable during our hold period. And I imagine that's probably the case for the vast majority of the deals that you guys fund. How do you underwrite when a company is burning, upwards of millions of dollars every month?
Yeah, that's a good question. So, I mean, I would say the reason why venture debt works, and why we can offer very affordable, cost of capital, is because when you think about it, there's a couple of ways to think about it, right? To how do we de-risk, or how do we underwrite to it? I mean, one is gee, if we have great investors on the cap table and they have some level of revenue and traction and a great team, is there a soft landing? So a company raises, 10 or 20, $30 million at $100 million valuation, right? Now maybe investors are hoping for $1 billion outcome, so they get their 10x or maybe more, depending on, which fund it is. But they're, if they're able to sell the company, if we only have $5 million of debt against that $100 million valuation, when you think about it that way, 5% LTV ish. Now it's a moving number and it's not solid, but is it relatively protected? And will that company that's doing, hopefully, by the time we have a situation, maybe they're doing a few million in ARR or maybe a lot more, and they have a team, could they be sold to some large tech company for at least the amount of the debt, right?
Yep.
So I guess that's one way to think about it. And which is why we have very low loss ratios.
Yeah. I've also heard there's also like, what's the likelihood of them making it to the next round is another kind of way to underwrite, because correct me if I'm wrong, but it seems like a lot of companies will refinance their venture debt over time. So, terms are a few years, and every time they raise new rounds of capital, they'll go back and kind of refi out their existing credit facilities.
Yeah, I mean, if we're doing a good job, they'll just refi with us. So we'll upsize with them if we have a balance sheet for it, right? Some lenders are capped. They'll say that they can grow with the company and they don't have the balance sheet to do so. But yeah, you're right. I mean, every time there's a new funding, we're getting in front of our customers and other competitor customers, right?
Sure.
To put out better terms, because that's a new time to look at it. And you're right. I think we have, like, at least I feel like I have a pretty good radar of how a company is doing today and how likely they'll be able to raise the next round.
Yep.
But for eventual outcomes, that's not our game, right? I mean, things can change in a couple of years where growth rate at scale, they're 50, 100% growth rate. You're like, well, sweet, they're going to raise. I don't know what valuation. I don't really care, because that's not our bag, right?
Yep.
And we get surprised on the upside and downside, but it's really just about, underwriting that next round more than the total eventual outcome.
Yeah. And it seems like, I mean, you guys definitely take a lot less risk, right? So if a company gets sold at a lower valuation, it might wipe out most of the VCs, but you guys will still oftentimes get paid back, plus your interest, plus even maybe some warrant coverage, if depending on where it's priced, right?
Yeah, I mean, that's the tricky part, right? So with like warrants, there are shops that will be in the money right away.
Yeah.
And so you need to be aware of that. And they're typically non-banks, but with us,
So what do you mean by that? They'll be in the money right away.
Well, so when you say like it's an option to buy, right? If you have like a put option, or you have there's no cost to exercise, then yeah, I don't want to say anybody's name, be out of school here, but like there's a shop or two I can think of that do that. There are very few that probably do that.
Just really aggressive on terms and basically say, hey, you're effectively going to give us equity in the form of a warrant, like a penny warrant, right? Where it's like,
right.
It only costs me a penny to exercise.
So you'll see it out there in the market. Sorry, there's a lag. What did you say?
Oh, I just said like a penny warrant.
Yeah, exactly. And I would say we're a little bit unique in that we will also do success fees instead of a warrant. And so for the very best companies that feel very confident about their outcomes, I mean, if you look at folks' earnings statements and things like that, like earnings calls, I mean, there are warrants sometimes that are in the millions of dollars, right?
Oh, yeah.
And so like huge hits, and a bank took a $10 million bet at some point, right? And maybe early days for the company. But because of that, I mean, having a success fee in the hundreds of thousands of dollars, or maybe $1 million or less, right, is sometimes very, very interesting to a company, right? And that's still, on change of control and M&A or an IPO, right? It's not like the end of the term loan being repaid or something like that. So it's still, when it's no longer going to be an issue, hopefully, for the company, right? So that's something that has differentiated us a little bit. But yeah, anyway, hopefully that answers your question.
No, that's really helpful. I'm curious, if I were an entrepreneur thinking about venture debt, meeting with different banks and non-banks, what are the things that should be kind of top of mind when picking the right bank or the right offer?
Yeah, I mean, I would say um, one, competition is good. So I would get multiple term sheets, right? Don't just get one bank term sheet because it's easy because you bank there already.
Yep.
Maybe get three if you can. If you can't, get two. And then same thing from the non-banks if you're really going to look at size and some other flavor. And then I would say look at what's actually usable. So, look at the structure and then ask yourself, do you feel comfortable with that team and their track record? And if you don't, maybe they have references, right? So I offer up, I have worked with these CFOs and these VCs and, would you like to talk to them about, and if they've been through cycles, right? How do they behave in a downward cycle, right? And if you see something that looks overly structured that you might trip a covenant and they don't look workable, or they haven't been through this that long, you might ask yourself if it's worth taking their money if you have other options.
Yeah. Yeah, no, I mean, it's very similar to venture, right? It's like, how do they behave when things are going sideways, right? And
Right.
you really want to be in bed with them, right? When tough times hit, because invariably in startup land, tough times are going to hit, right? It's just that's just the name of the game. So, yeah, I think having a good understanding of how they'll work with you, right, through problems versus just kind of lay the hammer down on you for breaking a covenant or what have you.
Yeah, it
Um,
was it was huge during the early days of COVID. So like when you think
yeah,
about it, nobody knew. Like you can all look in retrospect and forget about the last 6 months in the equity markets and private markets, but you can look back and say, wow, how great it was to be a SaaS investor or at any SaaS company. But no one knew the first few weeks, few months what was really going to play out. So a lot of people were cutting. And I had customers come to me and say, hey, I'm borrowing some of the line. Should I borrow the rest? And like there were several where I was like, you should totally borrow because like you don't know what will happen, right? And so having a partner that's willing to trust and know the business and be willing to do that in those times of uncertainty, I think is just worth its weight in gold.
yeah, absolutely. So switching gears a little bit, I know some of my listeners are younger, just starting their careers. Love to get kind of your advice. Like, what does a day to day look like? Maybe what are some of the pathways or pieces of advice that you would give to somebody that was interested in exploring this as a career? Things that they could do now to prepare.
Yeah, I would say take all the finance and accounting classes that you can. Work with people like Peter. Take internships at maybe tech companies. I mean, what helps me be better at venture debt is learning more about the VC ecosystem, right? And learning more about the startup ecosystem, what's going on in SaaS, and following folks on blogs, just those kinds of things, right? So if you're just getting your career start, I mean, there are multiple commercial banks that you could get started as a lender, and there are a lot of other paths that work too. For me, I just, looking at 80% of accounts receivable or whatever, there are a lot of folks that do that. Sometimes, it's an interesting role as well. But like for me, if you want to work at a venture bank doing venture debt, it could be a bank or sort of a shop. I mean, stacking your resume with some internships and being interested in the space, right? Because the people that show that, through their efforts, their experience, or their questions, show the most interest, they're going to get that job, right? And so I don't think that the bar is incredibly high. I feel like with VC, the bar is higher, right?
Yeah, for sure.
But it's a worthwhile career for a lot of people, and for me, it's been.
Yeah. Well, and it's fun, right? I mean, to your point, you're investing, albeit through debt, but you're still investing in companies and technology companies, right? Right alongside top tier venture shops. You're engaging with entrepreneurs, right? You're part of the whole story. And so I think for people that find that really interesting and exciting, but to your point, venture capital generally is like really hard to get your foot in the door. Venture debt can be like a pretty interesting alternative career pathway. Um,
Absolutely.
can you talk a little bit about like what your day to day is like?
Yeah,
What's a
sure.
typical day for Darell?
Yeah, I mean, it depends, right? I mean, there are folks at the bank that focus almost exclusively on new business, right? So they're networking with VCs, they're taking them to dinner, or they're, um, y- you know, just drumming up new opportunities, right? And I think we all do a little bit of that, certainly. And then a portion of the day might be for brand new customers, right? So we have, or I should say prospects, right? Where we're looking at a package, we're interviewing the CEO, CFO, VP of Finance, whoever it is that we have access to, and getting diligence and sort of beginning an underwriting process, right? But we also interview VCs as well, right? The folks that are on the board and understanding, why they're excited about a company. And so, but for our existing customers, I mean, we're doing upsizes, we're doing renewals, but we're also just getting regular reporting, and probably more regular reporting than some VCs, right? So some VCs are getting a board meeting, I don't know, once every couple quarters. It depends on the company, right? It depends on the VC and how many board seats they're on. But I mean, we're getting reporting every single month. And so sometimes when we're having these regular check-ins with VCs, we've actually surfaced things that they weren't aware of, right? Like, oh gosh, serious things as well about how there might be accounting for ARR that may not be actually booked or about to be recognized or what have you, right? And so there's a lot on the monitoring side of things, and nerdy internal reporting for banking too. So
yeah, that's great. Any fun war stories you're willing to share?
I mean, there was a company that sure. War story, gosh. I mean, we've had a couple of close calls on my watch. I would say, one company was growing like a weed and COVID hit, right? And they were massively impacted. It was sort of like this sports analytics space, and it was, no sports were happening live anymore. I'm not sure what ESPN was doing for a while. Those kinds of things, right? And I mean, we had to work that one very carefully together with investors to kind of understand what was happening and how we could sort of reduce exposure over time. We ultimately made a friendly introduction to a non-bank that could take much more risk than we could, right? It just became a better partner for them. Now they ultimately sold, everybody's happy, but it was just sort of like we were hamstrung to be able to do more for the company and probably less over time, and we communicated that effectively, right? And so we didn't lose any money. VCs may have not made the outcome they wanted initially, but they ended up, I think, at a 2x or something, their initial money. So it wasn't a terrible situation. We had another company that we ultimately almost kind of sort of replaced a round, if you will. We provided a $20 or $30 million line of credit, and that was a couple years before COVID. And they ended up leaning into the line. We're supportive of them, and the growth slowed, right? So like, we get excited when new investors, incremental lead investors, are going to be excited about a deal, right? And so if the growth is not there, it doesn't really matter what the valuation was before. It's about like, what are their exit paths now, right? And so I would say I wasn't really a war story, but COVID actually sort of re-accelerated that company, and we were able to help move sort of, from hundreds of millions of dollars of valuation to over $1 billion while leading into us. So I felt like we were a good partner there. I don't know if that's the war story you're looking for, but interesting company nonetheless.
No, I think it's great. Just, stories are always helpful to help solidify different concepts, and also be thinking about, how things can change and how things play out, right, in the real world. Like I love that your story from the perspective of, hey, here's a company doing really well. We were all excited about it. COVID hits, they go a little bit sideways. And as a great value add partner, right, you guys went and found somebody else that was willing to work with them, take a little more risk, right, and help them get to a pretty decent outcome, it sounds like.
It was, and it wasn't us sort of pushing them out before there was something ready either. It was a very together conversation with investors, with management team, and they provided like a couple $1 million more than we could provide. So it was just a much better fit. I think that I don't know if it was a war story, but there was a company that was like a Series A. We gave them a $5 million term loan, and this company decided to fund on their term loan a few months before going out for their raise, kind of in preparation for it. So it bolstered the balance sheet. And they ultimately, I mean, Series B, 160 million valuation, but but when we look back at it, it was sort of like, all they had left on the balance sheet was our term loan, right? And so you could say, wow, they didn't really need your venture debt, right? But what they did need was to point to a very strong balance sheet when they negotiated from a position of strength with their new investors. And likely that valuation would have been more like in the 1 to 120 range, not the 160 range, had they not had a strong balance sheet, because they were like on fumes. If you looked at it, like they had $5.1 million and 5 of it was ours, right?
Yep,
and so that was like a win-win-win for everybody, I guess. Maybe not so much the new leads on the Series B, but when you think about it, from a dilution perspective and the already involved VCs, it was great.
Yeah, I think that's a great illustration of how venture debt can be, super powerful, right? Because VCs can be vultures, right? They kind of circle around and they can go after weakness in a negotiation, just frankly, like any negotiation. So being able to walk into those negotiations from a place of strength, because you've got, cash on your balance sheet, and you can basically say, hey, if you don't fund us, it's fine. Like, we'll go find someone else because we got plenty of runway to get there. I think makes a huge difference. So, cool. Well, as we wrap up, any last thoughts or pieces of advice for entrepreneurs that are listening in, or those that might be interested in working in this field as a career?
Yeah, I mean, this career is totally accessible to you, your students, people that are listening. And I'm happy to be a resource if anybody wants to reach out. And I would say, aside from sort of, competition is a good thing. Get multiple term sheets if you're an entrepreneur. But at the same time, a lot of folks think that, oh gosh, I just raised a bunch of money. I've got all this runway in the world. What do I need to raise debt for? And we confront that all the time. But if they wait so long that the runway is tighter, we're not going to be an option, right? If it's big, and even if you're doing well to your plan, the questions can always going to be in our heads, like, why are you coming back to us now when the whole world knows? Like, if you're in the know and you're a smart person, you would know that you should have raised it 6 or 12 or 18 months ago. So what are we missing? Or did you misplan, right? So we have to ask ourselves the best and better and best questions, and also others. But so that's just sort of being a prudent, steward of your capital and your company.
Yeah, I think that's a great piece of advice to end with, which is, raise venture debt when you don't need it. And if it's not already on your mind as you go out to raise, an institutional round of capital, it should be part of the overall fundraising process, which I know, like, nobody loves fundraising, but to your earlier point, right, it's something that you really want to have at the right time, because it just gets more difficult later. So anyways, Darell, thank you for the time today. This has been really awesome and great seeing you again. And, hopefully for those that are listening, this was interesting and helpful. And thanks for joining.
Thanks, Peter.